The global precious metals market has been shaken by a stunning reversal that unfolded in a matter of days, catching investors and consumers off guard and raising urgent questions about what comes next. Good evening, and thank you for joining us. Tonight, we begin with a dramatic shift in the global precious metals market. After reaching historic highs earlier this week, the prices of gold and silver have fallen sharply, reversing a surge that had captured worldwide attention. Gold, which had climbed to a record level of $5,600 per ounce, dropped significantly in a short span of time. Silver, meanwhile, recorded its steepest percentage decline in more than 4 decades. These sudden movements have raised questions across financial markets and among investors, consumers, and analysts alike, as attention turns to the factors behind this abrupt downturn. At the center of the story is gold's rapid fall from its recent peak. Gold prices reached a record high of $5,600 per ounce before sliding to $4,770 per ounce. By Friday evening, the price had fallen further, with gold reported to be costing $470 per ounce. Silver followed a similar downward path. On Friday alone, the price of silver dropped by 31%. According to the data cited, this marked the largest percentage fall in the price of silver since March of 1980. The scale and speed of these declines stood in contrast to the strong upward momentum that had defined the market only days earlier. Just a short time before the drop, precious metals were trading at elevated levels. Gold reached a new record on Thursday at $5,600 per ounce. Silver was trading at $120 per ounce. These price levels reflected an intense wave of interest that had spread rapidly at the start of the year. As the calendar turned to early 2026, demand for gold surged, and what has often been described as gold fever reached a new high. Across multiple countries, people lined up either to sell gold they already owned or to purchase the metal at record prices. The surge in activity was visible at the consumer level. Many individuals visited local retailers to sell gold jewelry, seeking to take advantage of the elevated prices. At the same time, others entered the market from a different direction, buying gold coins or bars, sometimes for the first time. Alongside physical purchases, investment activity expanded through financial products linked to precious metals. Exchange-traded funds, which allow investors to trade the value of gold in a manner similar to shares, also attracted attention during this period of heightened interest. The momentum was reflected clearly in the United States market. On Wednesday, the spot price of gold in New York climbed to more than $5,418 per troy ounce. The troy ounce is the standard unit used to measure precious metals. This level marked a new record on the spot market. However, the upward trend did not hold. After reaching that peak, prices began to decline. By Friday afternoon, futures prices had fallen below $5,000. A move that some observers said could indicate a broader correction taking place in the market. The fluctuations in gold and silver prices did not occur in isolation. Market volatility intensified following reports that President Donald Trump would appoint former Federal Reserve official Kevin Warsh as governor of the United States Central Bank. News of this potential appointment leaked during the period when precious metals were already experiencing sharp price movements. The development added to uncertainty in financial markets, which often influences investor behavior, particularly in assets such as gold that are commonly viewed as stores of value. Despite the recent decline, gold prices remain significantly higher than they were 1 year ago. At that time, the spot price in New York was below $2,795 per troy ounce. This comparison highlights the broader context in which the current pullback is taking place. While the recent fall has been steep, it follows a prolonged period of rising prices that pushed gold to unprecedented levels. The rise in gold and silver prices before the drop has been linked to a broader atmosphere of uncertainty. Interest in buying gold and other precious metals, including silver, has tended to increase during periods marked by instability. This pattern has been observed in past global events and was again evident during the recent surge. Gold prices rose sharply around the world during the height of the COVID-19 pandemic. They also increased amid ongoing wars and periods of turmoil connected to President Trump's tariffs. The most recent records were set against a backdrop of escalating geopolitical tensions. Developments involving Venezuela and Iran were unfolding at the same time as heightened rhetoric from the White House. President Trump made repeated calls for a United States takeover of Greenland and adopted what was described as an increasingly aggressive stance toward America's allies. These factors coincided with the peak in precious metal prices, reinforcing the sense of global uncertainty that often drives demand for gold. Daniel McDowell, a professor of political science at Syracuse University, commented on this phenomenon in remarks to the Associated Press. He said there has been what he described as a real breakdown in the way we think about how the world order works, if we want to call it that. He explained that during moments of instability, buying gold has historically functioned as a psychological reaction for some people who are looking for a safe place to put their money. His comments reflected a broader understanding of how geopolitical and economic stress can influence investor behavior. At the same time, the surge in demand for gold and its subsequent decline have coincided with changes in the value of the United States dollar and questions surrounding the future independence of the Federal Reserve. The weakening of the dollar played a role during the period of rising prices. Concerns about monetary policy and the direction of the central bank added another layer of complexity to market conditions. President Trump's decision to nominate Kevin Warsh to lead the Federal Reserve has been closely watched. Warsh is a former Federal Reserve official, and his nomination is seen as a significant development. He would replace the current chairman, Jerome Powell, when Powell's term expires in May. President Trump originally selected Powell to head the Federal Reserve in 2017. Since then, the president has repeatedly criticized Powell, arguing that interest rates were not cut quickly enough. Kevin Warsh is described as a hawk in Federal Reserve terminology, a label used for policymakers who favor higher interest rates as a means of controlling inflation. President Trump has stated that he plans to nominate a new Federal Reserve chairman who would lower interest rates. According to the president, reducing rates would lower the cost of borrowing for the federal government's debt, which currently stands at $38 trillion. As we continue our coverage, attention now turns to the deeper sequence of events and conditions that surrounded the sharp movements in gold and silver prices. After the initial surge that pushed both metals to historic highs, the rapid reversal highlighted how closely the precious metals market is tied to shifts in confidence, policy signals, and broader financial conditions. The period leading up to the decline was marked not only by strong demand, but also by an unusual concentration of global and domestic factors that unfolded almost simultaneously. In the days before prices began to fall, trading activity in gold and silver intensified across major markets. Gold's climb toward its record levels was steady but decisive. By Thursday, the metal reached $5,600 per ounce, a figure that reflected weeks of accelerating interest. Silver, trading at $120 per ounce, mirrored that upward momentum. These levels were not reached in isolation. They came during a moment when investors, consumers, and institutions were reacting to uncertainty across political, economic, and geopolitical fronts. One of the most visible signs of this heightened demand was the surge in physical transactions. Retailers reported increased foot traffic as consumers brought in gold jewelry to sell. Many sought to take advantage of prices that were far above what they had seen in previous years. At the same time, demand moved in the opposite direction. Some buyers entered the market with the intention of holding gold as a long-term store of value. Gold coins and bars, traditionally favored by those seeking direct exposure to the metal, attracted first-time buyers alongside more experienced participants. Investment activity also expanded beyond physical gold. Exchange-traded funds linked to gold became another popular avenue. These financial instruments allow investors to gain exposure to the price of gold without holding the metal itself. Trading volumes increased as market participants sought flexibility and liquidity. This combination of physical buying, selling, and financial investment contributed to heightened volatility, setting the stage for rapid price movements once market sentiment shifted. In the United States, the spot market provided a clear snapshot of this dynamic. On Wednesday, gold prices in New York reached more than $5,418 per troy ounce. The troy ounce, used universally in precious metals markets, underscored the standardized nature of the rally. However, this record level proved difficult to sustain. Shortly after reaching that peak, prices began to retreat. By Friday afternoon, futures contracts had fallen below $5,000, signaling a notable change in direction. Futures markets are often viewed as indicators of investor expectations. The drop below $5,000 suggested that traders were reassessing their positions. While the article notes that this move may signal a broader correction, it also places the decline within the context of heightened volatility rather than a single, isolated cause. The speed of the fall drew attention because it followed so closely after record highs, reinforcing the unpredictable nature of precious metals markets. Another key factor during this period was the growing attention on the leadership of the United States Federal Reserve. News that President Donald Trump would appoint Kevin Warsh, a former Federal Reserve official, as central bank governor leaked, while markets were already experiencing sharp swings. This development contributed to uncertainty at a moment when investors were highly sensitive to policy signals. The Federal Reserve plays a central role in shaping monetary conditions, and any perceived shift in its leadership or independence can influence market behavior. Gold prices are often affected by perceptions of central bank policy. The article notes that fluctuations in value became more pronounced following the reports about Warsh's appointment. This suggests that traders and investors were factoring in potential changes to interest rate policy and the broader stance of the central bank. Such considerations are particularly relevant to gold, which does not yield interest and is often viewed as an alternative to currency-based assets. Despite the sharp decline, it is important to place current prices in historical context. Gold remains far above its levels from 1 year earlier. At that time, the spot price in New York was below $2,795 per troy ounce. The comparison highlights how extraordinary the recent rally has been, even after accounting for the pullback. While the fall from record highs was dramatic, it followed a period of sustained growth that had already reshaped market expectations. The broader environment of uncertainty played a significant role in driving prices upward before the decline. Demand for gold and silver tends to rise during periods of instability, and the article emphasizes that this pattern was evident once again. Investors often turn to precious metals during turbulent times, viewing them as a way to preserve value when confidence in other assets weakens. This behavior was observed during the COVID-19 pandemic, when gold prices spiked worldwide. The article also links recent price movements to ongoing wars and disruptions connected to President Trump's tariffs. These factors contributed to a climate in which uncertainty became a dominant theme, encouraging interest in assets traditionally associated with safety. The most recent records coincided with escalating geopolitical tensions. Situations involving Venezuela and Iran were unfolding during the same period. In addition, President Trump's repeated calls for a United States takeover of Greenland and his increasingly aggressive stance toward America's allies added to the sense of instability. These developments formed part of the backdrop against which gold and silver prices surged. Daniel McDowell, a professor of political science at Syracuse University, offered insight into this dynamic in comments to the Associated Press. He described what he called a breakdown in conventional thinking about the global order. According to McDowell, moments of instability have historically triggered a psychological response among some investors, leading them to buy gold as a perceived safe place for their money. His remarks help explain why demand intensified so quickly during this period. At the same time, economic factors were also at play. The article notes that the surge in demand and the subsequent decline occurred alongside a weakening of the United States dollar. Currency movements can influence precious metals prices, as gold is typically priced in dollars. A weaker dollar can make gold more attractive to buyers using other currencies, contributing to upward pressure on prices. Questions surrounding the future independence of the Federal Reserve added another layer of uncertainty. President Trump's nomination of Kevin Warsh to run the central bank was viewed as a potential signal of greater White House influence over monetary policy. Such a shift could mark a departure from the Federal Reserve's historic independence from political pressure, a principle that has long been central to its role. Kevin Warsh is expected to replace Jerome Powell when Powell's term expires in May. President Trump appointed Powell in 2017 but has since criticized him repeatedly. The president has argued that interest rates were not reduced quickly enough. Warsh, known as a hawk within Federal Reserve circles, has advocated higher interest rates as a way to control inflation. President Trump has stated that his intention in nominating a new Federal Reserve chairman is to lower interest rates. He has said that doing so would reduce borrowing costs for the federal government's debt, which stands at $38 trillion. These statements, combined with the nomination itself, became part of the broader context influencing market sentiment. In the end, the dramatic rise and sudden fall of gold and silver prices underscore how quickly confidence can shift in times of uncertainty, and how closely global markets remain tied to politics, policy, and perception. Stay informed as this story continues to develop, and if you want to keep up with the latest updates, be sure to like, comment, and subscribe.